Hello everyone, and welcome to another webinar from dbrown Consulting, and Happy New Year. So welcome to the Excel and Power BI Clinic. Today's theme will be financial modeling techniques, and I'm David Brown, and I'm glad to be hosting the webinar today. So we're going to have fun today. I think quite a few questions have been coming in for financial modeling, so I just want to touch a little bit more about financial modeling, but I'll talk generally about how we use Excel and how we can use Excel more efficiently. And this whole session is going to be very interactive, so we can always ask questions, put our hands up, and I'll try and get everybody involved fully. So use this wonderful tool that's Excel, that's so underutilized. So let's get started. All right, I always like to start with just a small poll, and I would like to know what your current business intelligence tool is. What business intelligence tool do you currently use? So I've put a poll up, and it's just asking what is your current business intelligence tool. So do you use Microsoft Power BI? Do you use Click? There's something called Tableau, very popular. Excel, of course. And then maybe you don't use BI tools. So let's see. Can we answer this poll? I'll be surprised if nobody picks Excel. Of course, Excel, most people don't even consider Excel a BI tool, but Excel is the most popular BI tool out there. Excel is used for BI, is used for all sorts of stuff, and in fact, IT guys kind of don't like Excel that much. It's, oh no, it's Excel. But Excel is so versatile. I mean, I just can't even start explaining how versatile it is. So, but they've actually modernized Excel. Microsoft has actually modernized Excel with some Power BI tools plugged into Excel. So maybe we'll touch a little bit on that as well today. All right, so I can see that 20% of us here are using Power BI already. That's good. No one's using Click, no one's using Tableau, and the rest are using Excel. So Excel, at least 1 billion people worldwide right now are using Excel. So that's interesting. Okay, so I'll just close the poll. All right. So for quite a few people who haven't done the webinars before, so I'm David Brown. I'm the one taking you for this small session. We do these webinars every month on the 3rd Thursday of every month. So the 3rd Thursday of every month, we do this webinar. We have other webinars we'll be doing this year as well, but this one is guaranteed. Every 3rd Thursday of every month, we do this webinar from 9 a.m. to 10 a.m. So I'm David. I've been using Excel for 22 years. I've been doing financial modeling for about 15 years, and currently do lots of BI reporting using Power BI. I'm also an international consultant to the World Bank on all revenue modeling. I'm a trainer, a master trainer, master instructional designer from ATD. ATD is Association for Talent Development in the US. So I develop materials for courses. I like teaching, basically, from a family of teachers, so I like teaching. So that's just a little bit about me. For this webinar, we asked that you write in your questions for the webinar. So I did like a word cloud of your questions. And you can see data analysis popping out a lot there, data analysis and analytics, business, pivot, financial, tips, Power BI, so, and then model in the middle. So data analysis and model, those are the top questions you were asking. And so that's why we're going to focus on financial modeling, because we've been getting lots of interest on financial modeling. So that's our focus for this webinar. All right. Now, if you have any questions, there's a chat room on the forum. You could go to the chat room and we could chat on the chat room. We have other trainers, other dbrown Consulting staff that can assist you as well. And if you have any questions for me, you can put your hands up, and then I can just release your mic, and then we have a chat. All right. So the outline for today is we're going to review the theme topic for the month. Then I'll answer your questions or some of your questions sent ahead, or just do a general Q&A. And then we have some bonus tips and tricks, and I have some special bonuses for you for this year. So as I said, the theme for this month is financial modeling. So on hands up, as in how many of us here have built a model? If you've built a model before, could you just put your hands up if you've ever built a model? Okay, you can see that no one's putting their hands up. But the thing is, when I say, have you built a model, what do you think a model is? The thing is, let me give you a very simple definition of what a model is. in Excel, if you want to build a model is something that has three distinct sections. And those distinct sections are inputs, calculations, and outputs. Once you have those three, you have inputs, calculations, and outputs, you have a model. So if you think about it, we build models every day because at the end of the day, you have a template where you put in some inputs. And those inputs have some calculations going on, and then there's one key output you need. So technically, you have built models. Anything you do in Excel is a model, most likely. Inputs, calculations, and outputs. The only difference is if you say financial model, the output itself is a P&L, that's profit and loss account, balance sheet, or cash flow statement, financial outputs. So that's just the difference. But a model has inputs, calculations, and outputs. So I'll ask the question again. So how many of us have built a model before? Just put your hands up. Yes, I can see more hands up now. Yes, we have all built models. Really, we've built models before. So yeah, okay, all right. Not many people are interacting. Okay, some people are not putting their hands up, so they haven't built models. Okay, all right. So that's modeling. So let's see. I'm going to let's look at a typical issue that people have with modeling. One very important thing about modeling is if you put your inputs, your calculations, and your outputs clearly, then you can use Excel for all sorts of wonderful stuff. The thing about Excel is we need to learn how we use Excel, how Excel works, and then when you know how Excel works, you can use it more efficiently. So there's one very interesting tool that Excel has that modelers always use. It's called a sensitivity analysis. We use it for sensitivity analysis. So we're going to do a quick sensitivity, and you try and understand how a sensitivity analysis tool, how the sensitivity analysis tool works, and how you can use it for any model that you build. It's a very powerful tool. So I'll just open a template we could use for it. Okay. So I'm just borrowing from our financial modeling training. We do financial modeling training. I have quite a number of very detailed modeling courses. So sensitivity analysis. If I go to building a sensitivity table, I've gone to a sheet called building a sensitivity table. So we can have a look at this and see how a sensitivity table would be very useful in a model. Now, as I said, a model just requires three things. We need inputs, calculations, and outputs. So here we're trying to mimic what a very typical bank model. So if you think about a model for a bank, we ask ourselves, how does a bank make money? I don't know. Maybe I would like to interact. Who knows? Okay, how does a bank make money? Can we go to the chat box and just type something there? What do you think? How does a bank make money? So I want us to be very interactive in this. So if someone wants to tell us how a bank makes money, could you just put your hands up and I'll put the mic up for you? How does a bank make money? Because that's the first thing in modeling. You need to understand, whatever you're modeling, you need to understand what are the drivers, what's driving this business, how does this business make money, and what does this business spend money on? And if you know that, the answer to that, you understand the drivers of the business, then you can start building a model. So Kayode would like to volunteer. That's good. Thanks, Kayode. So how does a bank make money? Kayode.
The bank makes money by the interest they charge on loans given out.
Okay, excellent. So the bank makes money on the interest they charge on loans given out. That's their main revenue source, right?
Yeah.
Okay, super. Is there any other revenue source apart from that?
Yeah. You see organizations, for instance, ICANN, that allows their students to pay their subscriptions to banks. So those commissions being charged, or those monies being paid, the banks equally make money from such commissions.
Okay, exactly. So the bank makes money from commissions, and normally when I see my bank statement, I see COT. I get pretty pissed when I see that. Then, of course, I see VAT, but that goes to the government, not to the bank.
Exactly.
And yeah, so the core for the bank, as you said, is loans, giving out loans, right?
Exactly. Yeah. Yeah.
Cool. So what is the driver? How, when you're building a model,
Yeah.
what are the things you need to be able to calculate that revenue?
Okay. The principal,
Mm-hmm.
the interest rate to be charged on the principal.
Okay.
So probably the output should be a sum of both the principal and the interest for a period.
Perfect. So you could see that Kade has just mentioned two drivers. The two main drivers is the amount of loan, the principal, which is the loan you give out, and the
Yeah.
interest you're charging for that loan. So if you look at this
Yeah.
model here, those two drivers are here. So here we have
Okay.
average loan amount. That's if you look at where I'm
Okay.
highlighting, average loan
Yeah.
amount. So that average loan amount, 1 million naira. So 1 million naira is my
Okay.
average loan amount. And then you can see loan interest rate. Right.
Okay.
So if
Yeah.
that's the average loan amount, we need to know, okay, how much, what's the total loan that this bank gave out? You can see customers with loans. Can we see that? Customers with
Yeah.
loans. So if you don't mind, Kaide, I'll put you on fully so we can just do
Okay.
this together, do this through together,
All
right?
right.
Excellent.
No problem.
With your background in banking?
Accounting. Yeah.
Accounting. Okay, so you're pure and pure
Accounting.
accountant. Nice.
Exactly.
I'm an accountant as well. But I
Oh,
always
that's a
pretend
good
I say,
one.
no, I'm a financial analyst because financial analyst sounds
Oh,
more, how would I call it, cool. So
exactly.
I say I'm not
Exactly.
an accountant. All right, super. So you
Exactly.
can see customers
Yeah.
with loan 600 and then average loan amount 1 million and then interest rate is
Okay.
5%. So what is the total
Yeah.
loan portfolio for this bank? The
Um.
loan portfolio or the total loan book for this bank is the average loan amount 1 million times the number of
Yeah.
customers with loans 600. So this bank has
Yeah.
given out loans of 600 million naira. So that
Yeah.
that is
Yeah.
the loan, how will I call it, is there a technical name for this?
Loan portfolio.
I guess so. I guess that's the loan portfolio.
Yeah.
Now,
Loan portfolio.
how does this bank give out those loans? There's something driving. A bank doesn't bring money out of thin air. So where does
Yeah.
this money come from for them to give
From
out
the,
as loans?
in most cases, from the deposits being
Exactly.
accepted.
hmm
Yeah.
So
From
really, the source
customers.
of that loan is the deposits. So when you're
Yeah.
building a model, you
Okay.
need to understand the drivers first, the main drivers. And in
Okay.
accounting, there's something I call above the line and below the line. I think it's a standard term in
Okay.
accounting. Above the
Yeah.
line
Yeah.
and below the line. So when you're building a
Yeah.
financial model, you have
Okay.
certain line items of your P&L, that's your profit and loss account, that
Mm,
is above the line,
mm,
and certain line
yeah.
items of your profit and loss account that is below the line. Now,
Okay.
every business has a gross profit. Let's just put it as
Yeah.
gross profit. Now, gross
Okay.
profit is what I call the line. That is the line. So gross profit is the
Okay.
line, and anything above it is really basically revenue minus expense or price
Expenses. Yeah.
price minus price times quantity minus the
Yeah.
direct costs that got that your price times quantity. So
Yeah.
for a manufacturing company, for example, the above the line will be revenue minus cost of goods sold, right? So
Okay. Yeah.
revenue minus cost of goods sold will give you gross profit. Now,
Yeah.
a firm of lawyers, for example, will have fees minus the direct costs that they use for those fees probably is their salaries, direct salaries
Yeah.
for those
Yeah.
fees, and then they get their
Yeah.
contribution. So that's
Okay.
basically how it works. For a bank basically has revenue coming in from loans,
Yeah.
and then which is basically interest. So interest in and interest out. So interest income and interest expense is the bank's
Okay.
above the line items, which will now give
Okay.
the bank their net interest income,
Okay.
and that's basically like gross profit.
Yeah.
All right.
Yeah.
So
Yeah.
that's the key for a modeler is understand that above the line calculation. Once you
Okay.
understand that above the line calculation, the below the line is usually typically the same for all companies.
Okay.
So, so below the line, that's below gross profit, every
Mm,
company pays rent. Every
yeah.
company pays salaries. Every
Yeah.
company pays tax. Every
Tax. Yeah.
company pays, I mean, all those below the line items are
Mm,
typically the same for all companies.
Yes.
So when building models concentrate on above the line, that's technically, the rest are basically generic. So for this bank, these are the above the line items. We have customers with loans, we have average loan amounts, we
Okay.
have average deposit amounts,
Okay.
and we have loan interest rate. So we'll calculate the loan income. So the loan income, if you look at the formula in here, we call these formulas natural language formulas.
Okay.
So if you look at it, it looks strange. It doesn't look like Excel. It's saying loan customers times average loans times loan interest. So this is typically the same thing as saying, let me just calculate it here, equals to customers with loans times, okay, can you see, when I went into this cell, instead of giving me what, B9, it's giving me loan customers. And that's because this cell has been named. It's just like coming to this cell and giving it a name. Once you give the cell a name, you can use that name in your calculations. So I could actually do the same calculation using just the cell references, which is equals to B, what was it, B9? B9 times B10 times what? B12.
Yeah.
And that's how you get that amount, you see? Same amount.
Okay.
All right. So this is our model. But really, we're not interested right now in building the model. What we're interested in is doing sensitivity analysis. And I'll show you how powerful sensitivity analysis is. So we've built this model, and this bank is making a net loss, isn't it, of 1.5 million. So let me make this a bit clearer. It's not very clear for all of us. Let me change the shading, shade it lighter. All right. So can we see that the bank is making a loss of 1.5 million. So let's assume we're in a board meeting and stuff, and we're like, okay, so how can we make profit? Or Kadi, what do you think the bank can do to turn this loss to a profit? What can it do?
Two things. Okay. We could raise the loan interest rate. Okay,
we could raise the loan interest rate. All right.
Yeah. So we could work on reducing the expenses too.
Okay, we could work on reducing the expenses. Perfect. Yeah. So we could raise the loan interest rate. So let's raise it by 1%. Let's see what happens, right? So I'm going to type 6 in there. So this is an input, and I'm changing the input to 6%. Yeah. Okay, can we look at net profit? Net profit moved from a loss of 1.5 million to a profit, so a loss of 816, right? 816. Yeah. It's still making. Yeah. So you can see that profit is sensitive to a change in interest rate. That's what it is. There's a sensitivity there. It's kind of sensitive. So what I've just done is I've created another scenario. So this is one scenario where, my interest rate is 5%. And another scenario, my interest rate is 6%, right? So this is another scenario. Let me check 7%. 7%? Okay, they're still making a loss, but it's 72,000. Let's say 8%. So 8%, the guy goes into a profit now. We're making a profit of 672. So you see, I just changed this. What I'm doing by changing one by one is I'm changing the scenario for loan interest rate. Yeah. Now, that is fine, but really a better way to do it is to do something we call a sensitivity table. A sensitivity table will have all the results of all these changes all in one place. So you can see what will happen if it is 5%, what will happen if it is 6%, what will happen if it's 7%, 8%, 9%, 10%. You see all of that in one place. And by seeing all of it in one place, you can make easier, better decisions instead of one by one. Now, this is one way of increasing profitability for this bank. What other way is there?
Like I said earlier, we could cut costs.
Okay, we could cut costs. So our costs here, we have some costs that are here. So in this particular model, we haven't given the costs any drivers. We've made them fixed somehow. So the only drivers you have in your model are these inputs. So these inputs are the only thing driving the model currently. So let's assume we can't cut costs. We could actually increase the loans we give out.
Yeah.
So the number of customers, instead of 600, let's assume our marketers have gone out and we now have 700 customers that we give out loans. So if I change that 600 to 700, okay, you can see profit has, loss has reduced.
Windowed. Yeah.
I change to 800. So you can see that changing just the customers, increasing the customers. So those are the two main drivers.
Okay.
So because we have two main drivers, we could do a sensitivity of them. So let me show you how that works.
Okay.
So I've created a small template to the right here. This is a sensitivity table.
Okay.
So all it is, I've just colored the cells. It's nothing special there, right? So what I want to do is I want to type out some interest rates here that I want to check. So up here, I'm going to just type some interest rates. So for example, I'll type 5% in the middle here, right? I could type 5% in here. I could type 6% here. Let me increase the interest rates by 1%. So I'll just say equals to this plus 1%, right?
Okay.
Okay, and I just drag that to the right.
Yeah.
And then this one here, I say equals to this minus 1%.
1%. Yeah.
And I drag that to the left. So these are the interest rates I want to check. I want to check how is profit when interest rate is 2%, 3%, 4%, 5%, 6%. Now, it is very important, right, that you type these things out. You don't link this. For example, you didn't see me saying equals to and going to link it here. You don't do that. In building this table, you just type out the inputs that you want to check. When this input is 5%, 6%, 7%. Now, if you look at to the left, I also have another set of inputs that I would like to check. Customers with facilities, right? So right in the middle here, let's assume I start at 600 customers, right?
Okay.
And then below here, let's say, should we grow by 50 or 100?
100.
And let's grow by 100. So I just drag that down. And by the way, the shortcut when you highlight like this and you want to take something down is Control D.
Control D, okay.
I just highlight like this and do Control D. Control D. D for down.
Down.
You know, most of us like mouse, right? We come here, we drag with our mouse. I hate using mouse. Anyway, so so this one up here is going to be equal to this, what? Minus 100.
Okay.
Right? So we copy, we take this up. So we have built our sensitivity table. Okay? Now, what I see some people do after building this table is something very funny, which is they come here to this model and they check, okay, at a customer of 600 customers and 5% interest rate, right? How much profit are we making? Yeah, with 600 customers and 5% interest rate, we are making a loss of 1.5 million. Yes? Isn't it? That's the model is currently telling us that with 600 customers and 5% interest rate, our loss is what? 1.5 million. So technically, this loss is inside this box. If I come to my sensitivity table, I'm just doing paste special values. So I'm pasting special values. You would agree that this is the value that should be here, right?
Yeah.
With 600 customers and 5% interest rate, that is the value right in the middle. Then I could come here and maybe change my customers to, let's say, 700, right?
Yeah.
If I change my customers to 700, what's my loss now?
560.
560, so I come and paste it here. Do you agree? Yes?
Okay.
So that's what a sensitivity table is. It's basically lots of results in one place. But this is quite tedious. You can imagine if I had to do that for every single cell here. How many cells do I have? This is, if I highlight this, how many cells is that? This is 10 by 10 by 8. So I have 80 cells in here, isn't it? So I have 80 cells in there, and with 80 cells, I can't start doing that. That means I need to change my model 80 times and then copy the results and paste it into this table. But that is very inefficient. So the most efficient way to do this is to tell Excel to populate it automatically. So technically, we're telling Excel, hey, give me the outputs for net profit in here. When interest rate is a certain amount, and when the number of customers is a certain amount. Yeah? So to do that, you build your table like we just did, and then you come to the edge of your table. Come to the corner, this corner right here. See this corner? Yeah. In the corner of your sensitivity table, you link the corner to the output you want to sensitize.
Okay.
All right? So that corner, I'm linking it to which output should we sensitize?
B30.
Yeah, exactly. B27. So that cell called a net profit. So once you link that corner there, then you now highlight your entire sensitivity table. Then you go to a tool in Excel under data. You go to the data tab. Under the data tab, we have a section for forecasting. By the way, this is Excel 2016. Excel 2016 has a very new, powerful tool called Forecast Sheet. Maybe I'll do another webinar on Forecast Sheet. This is so powerful. This is like building a model on steroids, and then it does projections for you automatically. So this is only in Excel 2016. But in all the other Excels, we have something called what-if analysis.
Okay.
So we have a what-if analysis. You would see that under data. So under what-if analysis, there are 3 options. We have scenario manager, goal seek, and then data table. So the data table is actually sensitivity table. They should have called it sensitivity table. So that is our sensitivity tool. So once you highlight your sensitivity table, you go to data, what-if analysis, data table, you click. Then your data table is asking only 2 questions. It's saying, okay, where are the inputs for the row and where are the inputs for the column? Can we see that? So yes. Row input cell is saying, okay, in this table that I have here that I'm doing a sensitivity, this row, you know this row here, row 32, this row has inputs for loan interest rate. We agree?
Yeah.
Yeah? And then in this my sensitivity table, this column has inputs for customers with facilities.
Yeah.
So what this sensitivity tool is asking is saying, what is the input in my row? So I click in here, I scroll up to my model, and in my model, I now select the cell that is being used in my sensitivity table for the row. So in my sensitivity table, the row contains different rates of interest. And this is the cell in my model that has interest rate. And then for the column, the column of my sensitivity table contains customers with loans. So we're just telling the sensitivity table, so this is where I'm getting those values from, or this is where I want you to be changing those values. Once you click OK, your sensitivity table automatically populates. So look at the sensitivity table now. Can you see? See the sensitivity table? It has populated with values. It's populated values, and these are all the values, possible values for all those combinations of interest rate and loans.
Okay.
So technically, if you remember, I was doing this manually. I came here, I changed this to 600. I changed this to 7%. Yeah. So you can see, this is my model. I can change this 600, 7%, and then I tell the people, maybe some investors are in my office and we're trying to review, okay, what about if you do very well and your customers are 600 and your interest rate is 7%? How will your company do? Oh, our company will still have a loss of what? 72,000. So this is good, but the thing is, I would like to see all the answers all in one place. So this
Yeah.
607% is already inside my sensitivity table. Look at it. At 607%, look at it, this value. At 607%, we have 72,000. So technically, what a sensitivity table does is it replicates your model. So this one has 80 results. That means this sensitivity table has 80 of my models inside it. It's almost like saving your model 80 times, all inside one single table. Which is why when you build a sensitivity table like this, you have to be a bit careful because this consumes memory. Because every single cell here is a model. Every single cell here, your entire model is inside that cell. So this is 80 models in one. Now, if you use this technique and you use it a lot in your modeling, I will advise you to tell the system not to recalculate every time. Because if it recalculates every time, it may slow your system down, especially if you don't have enough memory on your computer. So this is what you do. When you build sensitivity tables, and there are lots of sensitivity tables, best practice is you go to formula. Under formula, you have calculation options. Now, under calculation options, can you see the options there? Can you see automatic except for table? This one is for sensitivity, so it doesn't recalculate your sensitivities every time. So that's basically what sensitivity table does. I can see some other sensitivities, I can build other sensitivities below, but this is all about sensitivity table, and this is what you now present to your investors, that the only time we are going to be profitable is this is our feasible region for profitability, where I don't have red. So if CBN says we cannot have interest more than 5%, then we better tell our marketers to get at least what? 800 customers, right?
800 customers.
If we don't have more than, if we have less than 800, we're not going to be profitable. That's what that means. So this is a very powerful tool, very, very powerful.
Wow.
But before you can use this tool, you need to have a model, and the model must have 3 sections. So Kayode, I'll put you on the spot. What are those 3 sections you must have in your model?
Inputs, calculation, and outputs.
Thank you. So Kayode, thank you very much. I'll just cut your mic off now. Thank you. So,
okay.
Well done. Yeah. All right, so that's super. So we now know how to build sensitivity tables. I have another topic that I'll go to, but I want us to, where I'll talk about inflation index, and real and mode and depreciation calculations in your model. But let's leave that for now. Let's talk about, let me just put the mic up for anyone that has any questions so far. So if you have any questions, just put your hands up, and then we can now move to something else. Any questions? Any questions from anybody? Just put your hands up if you have a question. Okay. Nobody has a question. Oh, that's good. That means we understood it, or it means we didn't understand it. Maybe I confused everybody. I hope not. Anyway, so I would like us to do another poll so I just show that everyone is active. So let's do a second poll. So I would like to know which of these Excel tools you currently use and use proficiently. So I have a poll out there, and I'm trying to know, okay, which of these Excel tools and functions do you use proficiently? So, well, 100% of us use Vlookup proficiently. Wonderful. Okay, no, the percentage has reduced. Okay, 86%. We're still, you can pick as many as you like. Pick Vlookup, pivot table, Power Pivot, Power Query, Index and Match. Yeah? So Vlookup is one of the most popular functions out there. In our past webinars, I think we've talked about Vlookup a lot. If you want to see them, you can go to our YouTube channel. I'll put something up on the screen for you. You go to our YouTube channel and see how we use how to use Vlookup properly. Because even those that use Vlookup, there's some bad practices which you need to correct. So you could go check that out online. All right, so Vlookup, the final poll result, 86% of us use Vlookup very well, 71% use pivot tables, 14% have used Power Pivot, excellent, 14% have used Power Query, and very impressive, and even 29% of us have used Index and Match, super. There's one problem Vlookup has, right? I'm sure you guys know. For those that use Vlookup, Vlookup cannot look to the left, it only looks to the right, which is why a lot of times when you're doing Vlookup, you start changing your table. The table that you're looking up, you start modifying it and cutting something and taking it left and all that kind of stuff. That's very bad practice. You should never mess around with your reference table. So in that situation, you need to learn index and match. Index and match is far more superior than VLOOKUP. Again, you can go to our YouTube channel and we have videos on index and match and why it's better than VLOOKUP. All right, so that's cool. Thanks for that. Let me close the poll. Okay, so I've closed the poll. Let me get back to our slides. And of course, this is still Excel. I'm sure you know. I'm using a different tool or technique to make it look like slides. So we have a meetup group. Some of you joined this webinar through our meetup group. So we have a Nigeria Modern Excel and Power BI user group. So this user group just has free meetups. So currently, this is a meetup we're doing right now. It's an online webinar meetup. And we're going to have live meetups this year. So we're looking for sponsors, and what happens is we are sponsoring the venue. So we will provide the venue, and we provide the trainer or the speaker. What we need is sponsorship for maybe meals or snacks, and then we can just set up any meetup. We're hoping to do at least one live meetup every quarter. So that means live, as in we come to an actual venue and talk about Excel and Power BI and stuff like that. So join the meetup group and then send through your suggestions, and let's see if we can. We already have almost 500 people on that group. So just join, and then we can set up some live meetups. And it's all free. Yeah, it's all free and good. So if you're interested in that, please join the group. We also have a YouTube channel where we're dumping all the videos, especially this one, for example. You're going to get the video for this in the email. You get the video for this webinar, and then you can also go to our YouTube channel and watch all those webinars and stuff. All right. Now, usually when I do this training, I always talk about certain bad practices that we kind of we as analysts, we that work with Excel, there's certain bad practices that we have. And from my research, 80% of our time is spent trying to get data, connecting to data, copying data, cleaning data, doing VLOOKUP, reshaping the data, and all sorts of stuff that we do every week and every month when we're doing reporting. Yes. So we get all this data, copy, paste, copy, paste, copy, paste. Eventually, we get a chart or something, and then we put it in PowerPoint, and then we present. That's the life of nearly 80% of the analysts that I know. All this copy, paste takes a lot of time. It's quite inefficient. If this describes some of the stuff you do, put your hands up. Confess. Just confess. Put your hands up. If you do this, because I do that too sometimes, and it's quite annoying, but you're like, okay, but the data is coming from all sorts of sources, it's not clean. In fact, the data comes from IT. IT gives us a data dump every week, and then we need to get a report out of it and all that kind of stuff. So that's what we tend to do, right? But that's not efficient. What is really efficient is you need your data to be automated. The data is automated. So maybe if IT gives you data, just take that data, dump it into a folder, and then press a button, and every report you have is automated. Now, that is possible. That's the best way to work in Excel. So that is possible. So you should spend the rest of your time actually analyzing and doing analytics, visualization, data exploration. That's what you should be spending your time doing, not spending your time copying, doing VLOOKUP and all those stuff, right? So you're in luck. I've spent my vacation period building a very solid training that covers this. So the training is on report automation in Excel. So report automation in Excel, it will show you how to automate any report in Excel from scratch. So you can imagine you have 100 Excel spreadsheets somewhere. Every week you get a spreadsheet. Every week you get a spreadsheet. And you have that for the last 3 years. All you need to do is dump all of those data into one single folder, and then you build this entire reporting engine in Excel. You don't need VBA at all, just Excel. And this kind of dashboard comes out every single day. And once your data updates, once you maybe get a new data for the month, all you need to do is dump that data into a folder. And when you open this report, it will automatically refresh, and your data just automatically refreshes. So you're going to build this exact dashboard in that training. I think it's about 4 hours of online training. We're launching the training on the 30th of January. Who is interested in this training? who is interested in attending or getting maybe a special bonus discount or something on this training. It's going to be a very cheap course online. We're going to make it very cheap and affordable, but I would like to give guys here that in this webinar a special discount rate. So, and the funny thing is I'm so confident in this, we're going to have a money back guarantee. We are going to assure you that after this training, within 6 months, you should get a promotion. You should either get a promotion or get a commendation from your organization because you have basically solved a lot of internal problems when it comes to reporting. So that's a guarantee, money back guarantee. If you don't get a promotion in 6 months or a commendation, get your money back. So if you're interested in this, please shoot us an email to training@dbrownconsulting. Just state you've attended this webinar. In fact, we'll have your email address already, and then we'll give you a special discount for that. Okay, so any questions? Should I go to the next topic for financial modeling? Or do you guys have any questions? I have another topic for financial modeling where we talk about inflation, indexing, and stuff like that. Are we interested in that? Put your hands up if you should do that, or you think we should do something else. Or if anyone has, if anyone wants to talk about or chat about something else, can you just type something in the chat box or the question box? You could type something out. Let me see, there's some questions already there. Let me read out some questions. Okay, okay, some people, they're interested. Okay, somebody came quite late. Hamid, you came late, you can see that. Okay, I'm just reading some of your questions there. Okay, okay, some people also use pivot tables. Please, can you add me to the monthly meetup group? Okay, so monthly meetup group, all you need to do is click on the link, go to, if you go online and just say, what's our meetup called? Let me just check that. Our meetup group is called, let's see, what's the meetup group called? Okay, the meetup group is called Nigeria Modern Excel and Power BI User Group. So if you just go online and go to meetup.com, if you go to meetup.com and just type Nigeria Excel Power BI User Group, the meetup group should come up. And then you can just add, it just adds you to the group, right? So that's that. Okay, we are going to go into another Excel. Let's see what time we have. We have about 10 minutes left. So we just quickly look at another modeling challenge that many people have. And let's see if we can help solve that. So I've just opened an Excel template that we use in some of our modeling courses. All right. Okay, so there we have a small template. All right, so I have real versus mode versus inflation index and then depreciation. I don't think we can cover depreciation right now. So depreciation maybe for the next webinar, I'll do the indexing. Now, whenever you build a model, you need to, if you're building a model, let's say for 10 years, I'm building a financial model for the next 10 years. Let's assume I'm building a model for, and in the model I need to calculate depreciation, or I need to calculate depreciation on motor vehicles. Now, if I say I'm going to buy a motor vehicle for 10 million naira next year, now, what am I actually saying? I'm buying a motor vehicle for 10 million naira next year. Is it that I'm going to use 10 million naira next year to buy that motor vehicle, or is the cost of the motor vehicle 10 million naira today? Because next year the cost could go up. In fact, Nigeria, cars that cost what, 5 million before are now 15 million. It's ridiculous. No one can really buy a new car anymore, unfortunately. So if I say, okay, I'm going to buy a car, I'm going to replace my car in 5 years' time. In your financial model, you have to go to 5 years' time and type a value in there. So what is the best practice? Do you type the value of the car as it is today, or you type the value you think the car will be in 5 years' time as your input? For me, the best practice is type the value of the car as it is today. Just type that. So in 5 years' time, just type the value of the car that it is today's price, in today's money, and then use an inflation index. Use an inflation index to kind of grow that money, to grow that value. So use an inflation index, and the inflation index will automatically update that value. So to put an inflation index, there's a system. The system basically allows you to automate your inflation index. That is, we can change the year. If you look at this row I have here, I have a row up here. Let me increase the size of this sheet so you can see it clearly. So at the top here, I have money stated in 2016 real terms. So what I mean here is all the money you see in my model, I'm stating it in 2016 money. So if you see in 2020, you see 20 million naira for buying a car. What we mean is that is 20 million naira in 2016, but in 2016 money. So 2016's money, we're using it to buy a car in 2020. So that means in 2020 is obviously going to be much more than 20 million. And the way we're going to adjust it is an inflation index. So indexing starts at 100% normally. So I'm going to type 100 into this cell. That's the first step. So I type 100 into this cell, and then I use an inflation rate or various inflation rates to calculate my to grow inflation. So right now at the corner here, I have annual fixed capex inflation rate at 8%. So this 8%, I'm just going to link it up here. I'll lock it. You lock by pressing F4. So I lock it, this 8%, I'm going to have this 8% up here. Control R. Right. So that's my inflation rate. Then this is an inflation adjustment. What I do with inflation adjustment is for every particular year, I can adjust each year, increase or reduce the inflation for each year. At the end of the day, my annual inflation rate is just going to be a sum of this inflation rate plus the adjustment. So this becomes my inflation rate for each year. I can decide that for example, in Nigeria, 2016 and 17 was so bad. Let's say I'm going to increase it by 2%. So which means inflation for these 2 years was 10%. Yeah. It is very important when you build a model that any key input that is a very important input, inflation is a very important input. It should be in only one cell. One cell. Don't type this input into many cells, or else you can't do sensitivity analysis. If you think about it, the sensitivity analysis we did before, all those inputs were in one cell. So once you have your inputs in one cell, to adjust each year, you just have an adjuster. This row is an adjuster. So you can adjust what the inflation was in each particular year. You can adjust it. I can say -2. That way, we can do sensitivity analysis on this cell, all right? Anyway, so let's quickly do the index. How do you create an inflation index in your model? You first of all start at 100. Then you come here and you basically grow your inflation. You say equals to that times, open bracket, 1 plus your inflation rate up here, right? And we just drag this to the right. Okay, so we just drag it to the right. So this is basically inflation factor. But the issue is this: if our inflation start year is 2016, that means that this column, this 2016, it should actually, the 100 should actually start here. It should be 100 here, and then grow this way, and then this one will be deflation. So that's what this indexing. We want to index as at 2016. Currently, we're indexing as at 2013. So to do that, there's some small tricks we're going to do. We need to come to this box, and in this box, we need to go and pick what the inflation indexing system was for 2016. So if someone types 2016 here, I want this formula to come here and pick 2016. If somebody types 2018 in here, I want this formula that I'm going to type in here to go and look for 2018. That's this one. So to do that, we're going to use index. Index is the method we're going to use. We're going to say index. And for those that don't know index, index is one of the most powerful functions in Excel. It has 2 versions. You can imagine that a function that has 2 versions I think is probably the only function that has 2 versions. Yeah? It was just too powerful. They had to make 2 versions for it. Anyway, so we use the first version for index. And index asks for 3 things. Index is asking for 3 things. It's saying what array, what row number, what column number. What array means is basically a selection. So for example, I can highlight this. This is an array, all right? This is an array. So when you have an array, this array has rows and columns. This one has 1, 2, 3 rows, and how many columns? 1, 2, 3 columns. So if I tell it, go to row 2 and go to column 1, what I'm telling it is, in this my array that I highlighted here, go to the second row and the first column. And what is in the second row and the first column is annual inflation adjustment. And if you look down here, you see that's exactly what the formula is showing us, annual inflation adjustment. Anyway, for us to do what we want to do, we need to, the array we need to highlight is this values here, from here to the end. That's our array. And in this array, the row I want it to go to is just 1, because this is only 1 row. This whole thing is just 1 row. But the column I want it to go to is whatever column is 2016's column. So if you look at it, the column is whatever, this is column 1. Yeah, this is column 1, isn't it? This is column 1. This is column 2. This is column 3. So I need it to automatically identify where 2016 is. It's 2016 column 1, column 2, column 3, column 4. And the function that helps do that is called match. So if you want to type a function inside a function in Excel, the technique is type the name of the function and then open and close your bracket. That's the trick. Type the name of the function, open and close your bracket, and then go into your formula bar at the top. Select the function in your formula bar. Once you do that, this argument box automatically changes to match. Can you see that? This is now match. If I go into the formula bar and select index, this argument box changes to index. Match is invalid because we haven't done anything in match. If I go back to match, you can see it's changed again. So what are we trying to match? What I'm trying to match is this value here, this 2016. I want to match it to all of these years up here. And then my match type is 0. Just take 0 means look for an exact match. So when I go back to index, we see index has finished its work, and we say, okay, now we've got 126. That is this 126 here. All right? This 12 is 125.97. That's 126. If I change this year, my indexing year to 2018, guess what? This now changes to 146, which is this one. So that's that. We're almost done with our indexing system. So just bear with me for 2 more minutes. So 2016. So now I'm going to use this to basically do some calculations. So I'm going to use that to calculate my indexing system. And a way to do that is we come to this cell. We'll say equals to this particular cell here, which is H19, which you need to lock. And then we divide it by this index up here. Then we drag this all the way right again. Now what this is doing is you will now see that 1, which is like 100, is under 2016. And then all of this is basically almost like a discount factor. This is like a discount factor, right? And based on that discount factor, we need to now calculate what is our inflation or our deflation rates going to be. This is a little bit technical for you guys for normally, but if you watch the video again and just practice this many times, you understand why we need to do all of this in a model. Yes, a little bit technical. The next one is even more technical because what your inflation index should be normally, right, is it should be, if you think about it, this should be 1.08. This 1.08 and this all this stuff should start from here. Now, if my whole inflation indexing system is 2016, that means when my user enters a value for my model, in my model, enters, I want to buy a car for 10 million naira. When he puts 10 million naira in 2020, it means that 10 million naira should grow based on inflation. But if he puts 10 million naira in 2015, since our year starts in 2016, that means that is what he used. That's what he actually spent in 2015 or 2016. So we need to use an if here. We need to say if, for example, if the year, which is I6 here, if this year, right? If this year is less than the indexing year, if it's less than the indexing year, right, then just give me 1. That means there's no inflation. It's just 1. Whatever the user typed is what it is. If not, give me 1 divided by the value that I've calculated already at the top. And we close our bracket. Now, if I drag this to the right, you would see that this is 111, and then we now have an inflation index here. This is inflation. So in 2014, 15, 16 is in the past. Then we grow by 8% based on inflation, 8%. We now grow by another, this is the cumulative inflation factor. So technically, this is where we're heading to. This is the inflation factor that we need to use. So that's how you calculate an indexing system. And at the end of the day, your user only needs to come and change this year to whatever year the indexing system is starting from, and you can see everything works. Since my indexing system starts in 2018, 2018 will be 1, 2019 we grow by 8%. If I change the inflation to 10%, everything grows by 10%. So you can see this is 10%, then 1.21, 1.33, and these values are what you now use to get the inflated values for your money of the day. So if I'm spending 10 million, so my money of the day is going to be equal to this times the inflation index, and you grow that. So if I assume that I'm only buying a car, 10 million naira cars every single month, 10 million naira cars, that 10 million naira car is worth, if you want to buy a 10 million naira car in 2024, you need to spend 17.7 million. So that's how an indexing system works, an inflation indexing system. All right, so quite technical, I know. And let me allow one more person to ask a question, and then we're going to call it a day. And just before we do that, let me quickly put up something on your screen. Where is this? All right, you can see something here. Okay, this is another offer I'll give you guys. We have a financial modeling training where we go deep into, this is just one tiny aspect of it. April 3rd to 7th, a detailed financial modeling training. And if you're on this webinar and you can prove that you actually attended this webinar, you get a 30% discount on our course. So you just need to call 0700 training, and then you get a 30% discount. And these are all the other courses we have. These are live courses, not the online one I talked about. The live, you just come to our training center. So we have Power Excel 1, which is Essentials of Excel, in February 6th to 7th. February 8th to 10 is Power Excel 2. We have Creating Executive Dashboards. We have Introduction to Power BI. We have all our Power BI courses in May. And then we have the Financial Modeling School in April 3rd to 7th. So you would learn this and much, much more. You build a model from scratch. Learn how to get the financials of a company and build the detailed model and valuation from scratch. So you could send us an email to training@dbrownconsulting.net or 0700 training, and you get a 30% discount. So anyone with any questions before we call it a day, or like any comments, anything you think we could do or change for this to make these webinars better, just put your hands up if you have any questions, and I'll put your mic up. Okay, Vinod, I don't know if your hand is up. Vinod, do you have a question? Hello, is this Vinod there?
Okay. Yeah, I'm okay. No questions. Thank you.
All right, Vinod.
Can you hear me?
Yeah, I can hear you. Hi, Vinod.
Hi.
Hi, I saw your hand up. I thought you asked the question.
No problem.
Okay, so how's the webinar? Did you gain something from it? Was it good?
Yeah. Actually, I learned the sensitivity.
The sensitivity. You're going to use it, I hope. You'll be using it? Okay. Sorry, Vinod, can't hear Vinod. Okay, thanks a lot for Vinod. Any other question? One last question, and then we call it a day. Who has a question? Chukuma has a question. Then put your mic up. Hi, Chukuma. Hello, Chukuma, are you there? Hello, Chukuma. Okay, he's not there. So if you guys don't have a question, well, I'm a trainer. I have a question. So I'll give you our last poll. And I would like to know which of these modern Excel tools, which of these modern Excel and Power BI tools do we use? So this is our last poll for the day. So if you just tell us which of these tools do you currently use? Okay, poll answers are coming in. Yeah. So do you use Power Pivot and DAX? Do you use Power Query and M? Do you use Power View? Do you use Power Maps? Or you don't use any of these new modern Excel tools? Okay, interesting. 43% of us have used Power Pivot and DAX. Okay, about 60% of us have never used any one of these tools. So all these tools are available. They're available especially in 2013 and 2016, and they are free. The nice thing is they are free. Especially if you have even 2010, you can download Power Pivot for free and Power Query for free. In 2013, you need to have Professional Plus, and then you get the tool. In 2016, you need to, in 2016, Power Query already comes in. Most of them are already there in 2016. So just try and go online, do some research, download these new tools, and start using them. Excel has changed. Excel is a really powerful BI tool, and it really is very, very powerful. And as I said, those that are interested could send us an email for the online course which we are launching on the 30th of January. It's a very, very powerful course, and it will make you automate any report you have. And we have a money-back guarantee because we're so sure that you're going to get a promotion in 6 months. So 6 months after doing this online course, you should get a promotion or a commendation at least, or you get your money back. So thanks, everybody, and thank you for attending the webinar. And we have this every month, third Thursday of every month. And please join the meetup group because we're going to be having live meetups as well. So thank you, everybody, and enjoy. And you should get an email with the link to this video once we're done. Thank you, guys. Bye-bye.